All right, guys, welcome to Sharpen Your Edge, Learn to Trade Fearlessly. This is session 17. We're going to be going through VPA chapter 7, Support and Resistance Explained, which is very similar to what we do with our zone system. So this has a lot of relevance to what we do every day. The loss was not bad luck. It was bad analysis. Written by David Einhorn many years ago, and that's true. So support and resistance. So, so far in this book on volume price analysis, we've focused on the pure relationship between volume and price. Now, in this chapter, I'm going to introduce the first of our analytical techniques, which helps to give us our perspective on where we are in terms of price behavior on the chart. And more importantly, when combined with volume price analysis, this technique also reveals when trends are about to start or end, and equally when markets are moving into congestion phases. Now, to use a building analogy for a moment, if volume and price can be considered the foundations, then the analytical techniques I explain in the next couple of chapters are the walls, floor, ceiling, and roof. In other words, they provide the framework for volume and price. The VPA on its own is really powerful. However, what these additional techniques will add are the markers, the signposts, if you like, as to where the market is in its longer-term journey on the chart. Let me begin with the first of these techniques, which is known as support and resistance. Once again, this is a powerful concept which can be applied to any market, any instrument, and in any time frame. So whether you're using VPA as a scalping intraday trader or as a long-term investor, support and resistance is one of the key principles of price behavior on a chart and a central plank of technical analysis. So let me recap the basics of price behavior. In broad terms, a market can only move in one of three ways, right? It can either move up, down, or sideways. In other words, a market can only trend higher, trend lower, or more sideways in a consolidating phase of price action. Of these three states, markets spend considerably more time moving sideways than they do trending either up or lower. And a rough rule of thumb, this is generally considered to be around 70% of the time, while only trending 30% of the time. Markets move sideways for all kinds of reasons, but primarily there are just three reasons. First is the pending release of an item of fundamental news. To see this in action, simply watch the price action ahead of any major fundamental news release. Prices are likely to trade in the narrow range for several hours ahead of key economic data. Now, this is one of the reasons why Keith gives us a reports report every morning, so we can be looking out for it and how it affects the market. Secondly, markets move sideways in both the selling climax and the buying climax phases when warehouses are either being filled or emptied by the insiders. Remember our talk about how the market makers are big warehouse owners. When price is going down, they are filling the warehouses. When price is going up, they're selling out. And third, and finally, markets move sideways when they run into old areas of price, where traders have been locked into weak positions in previous moves. As the market approaches these areas, speculators and investors grab the chance to exit the market, usually grateful to be able to close out with a small loss. Whatever the reason, areas of support and resistance will look something like what you see on the screen. This price behavior appears on all charts with clearly defined areas where the market has moved sideways for an extended period. Now, the analogy that I always use to explain this type of price action is that of a house with floors and ceilings, which I hope will help to fix this more vividly in your mind's eye. Now, what's happening in this graphic? Well, to begin with, price has fallen before reversing higher, only to fall back again before reversing higher once more. And this zigzag price action is repeated over and over again. And as a result, has created a channel of price action with peaks and troughs as shown on the screen right here. This oscillating price action creates what we call the floor of support and the ceiling of resistance. Each time the price action comes down to the floor, it is supported by what appears to be an invisible cushion. Not only does this help to prevent the market from falling further, but also helps the price to bounce higher. Now, this is akin to our demand and supply zones very much, and we see pretty much the same behavior when we set out the zones. Now, once the price has bounced off the floor of support, it heads back toward the ceiling of resistance, where an invisible barrier appears again, this time preventing the price moving higher or pushing it back lower again. Now, at some point, the price will break out from this region. However, before moving on, there are several points I'd like to examine, and the first and perhaps most obvious is, why is this price action so important? Therefore, let me try to address the issue here. Suppose for a moment that the price action on the screen is taking place following a long bullish trend higher, but this is not a selling climax. What is actually happening in this scenario? Well, first, the market has moved higher. Buyers are still buying into the trend, but then the price reverses and moves lower. The buyers are trapped at this higher level and are now regretting their decision. They are trapped in a weak position. The market moves lower, but then starts to move higher again as buyers come in at this lower level, fearful they may miss out on another leg higher in the trend. As the market approaches the first reversal point, those buyers in a weak position sell, glad to exit with a small loss or really even a break even if possible. This selling pressure sends the market lower, away from the ceiling level, with a second wave of buyers now trapped in a weak position at this higher level. The market then approaches the floor again, where buyers enter, seeing an opportunity to join the bullish trend and take the market back to the ceiling again, where the second wave of weak traders sell out and exit with either a small loss or a marginal profit. This oscillating price action is then repeated. And really, there's nothing magical about these price levels of the floor and the ceiling. They simply represent the extreme psychological levels of fear and greed in that particular price region in that particular time. Now, we must always remember price action is fueled by these two basic emotions. And it is in the price congestion phase of market behavior we see these emotions in their most basic form. At the top of the first wave, greed is the overriding emotion. By the time the market returns to the second wave, fear and relief are the overriding emotions for these traders. As we can see on the screen, it's all very logical once we begin to think of it in terms of emotional buying and selling. Now, the overriding emotion as the market hits the top of the first wave is greed, combined with the emotion of fear, the fear of missing out on a good trading opportunity. Now, remember, these traders are weak anyway. Why? Because they've been waiting and waiting, watching the market continue higher, frightened to get in, as they are nervous and emotional traders, but at the same time frightened of missing a golden opportunity to make some money. After all, they have seen the market rise and are now wishing they had entered earlier, and they eventually buy at the top of the first wave, of course. The market then promptly reverses, and they immediately become fearful of a loss. In fact, that happened on our last trade. The market moves lower, then bounces. At the bottom of the first wave, buyers come in, entering on the pullback and pleased to be getting into the market at a so-called good price. The market moves back higher towards the top of the first wave. The buyers at this level cannot wait to exit as the fear drains away and they get out with a small loss. Remember, throughout this phase of price action, they have never seen a profit, only an increasing loss, which has then reduced back to zero, close to zero. Their emotional level of fear, a fear indicator if we had one, would have been rising steadily on the downwards leg and then falling on the upwards leg, but at no time was their position in any sort of potential profit. So this group is simply pleased to exit with just a small loss. After all, At one point, the potential loss could have been much worse. So this group considers it has done well in closing with just a small loss. And remember, too, that this group always trades on emotion anyway. So it's almost always in a weak position when they open any trade, and therefore very easy to manipulate using emotional price swings. So, do we see the same at the bottom of a trend lower? Yeah, well, the answer is yes. We have exactly the same principle at work here. The principle here are exactly the same for the bullish trend as we looked earlier. And we can see on screen the market has been in a downtrend for some time. And once again, the weak emotional traders are drawn into the market just as it is about to reverse. They have seen other traders making nice profits from the move lower and finally overcome their fear of trading and make an emotional decision to join the market. And what happens? Well, the market immediately reverses against them and bounces higher, locking them instantly into losing positions, which then worsens. Fear mounts as the losses increase. Finally, the market reverses back to where they first entered their position, and they exit, believed to have been able to close out with just a small loss, or possibly a big loss. The strong traders are selling into the market at the top of the waves, and their positions are generally positive throughout the market move back and forth in the trading range. Of equal importance is when the market pause is one of these areas, but then continues on in its journey in the same direction as the original trend. Both of these have important consequences and send us key signals, all validated with volume, which we'll look at in a little bit. But first, let's set out some general principles when using the analytical technique. And the first principle, the lines we draw on charts to define the ceiling and the floor of these price regions are not rods of steel. Consider them more like rubber bands with some flexibility. Remember, technical analysis and VPA is an art, not a science. Now, while these levels do constitute barriers and platforms, they're not solid walls, and on occasion you'll see them broken, only for the market then to move back into the channel once again. Consider them to be elastic with a little bit of give. Second principle, always remember Wyckoff's second law, the law of cause and effect. If the cause is large, this will be reflected in the effect, which applies to support and resistance. In other words, the longer the candles, or the more the volume, the longer the candles, basically, and more the move. The longer a market consolidates in a narrow range, the more dramatic the resulting price action once the market moves away from this region. Naturally, this is all relative, not least because the market has been consolidating on a daily chart for several weeks or several hours. It's likely to trend for a similar period, while any breakout from a consolidation phase on a 5-minute chart may only be for an hour or so. It's all relative. It can happen on a 1 minute, 5 minute, 30 minute. It's just all relative. Remember, the law of cause and effect introduces the concept of time. And the third principle is perhaps the one which perplexes most new traders, and it's this: how do I know when the market is in congestion? After all, it's easy to look back in hindsight and see where the price action has been consolidating for some time. But when the market action is live, it is only after the event any consolidation phase becomes self-evident. This is where the concept of an isolated pivot high and an isolated pivot low become key signals. And while there are indicators available to create these automatically, they're pretty simple to spot visually. In this one, isolated pivots, these are the defining points for the start of any congestion phase. And the easiest way to understand pivots is to suppose the market is moving higher in an uptrend, and we see an isolated pivot form on the chart. We have now seen the first sign of a possible weakness in the market. Now, these pivots are caused by 3-bar candle reversals as shown on screen. Now, to qualify as a 3-bar candle reversal, the candle in the center has to post a higher high and a higher low, creating the pivot high pattern. The appearance of one pivot does not mean we're moving into a congestion phase at this time. All we can say at this stage is we have a possible short-term reversal about to happen. Now, We are waiting for the equivalent isolated pivot low to be created. This occurs when we have a 3-bar candle pattern where the center candle has a lower low and lower high than those on either side. And again, if you look at the right side of the screen here, that's an example of a pivot low. Once this candle pattern appears on our chart, we can now draw the first 2 lines to define the ceiling and the floor of our congestion zone. Now, the pivot high is the ceiling and the pivot low is the floor. Now, these simple candle patterns not only define the start of any congestion phase, they also define the upper and lower levels as the market moves into a period of sideways price action. And this is referred to as congestion entrance, as we could see on the screen. The same applies when the market has been falling. Excuse me. The same applies when the market has been falling and enters a congestion phase. Now, here we are looking for the reverse with an initial pivot low followed by a pivot high, which we can see in this graphic. At this point, we now have our ceiling and floor clearly defined, and as the market moves further into congestion, we see further pivot points to the upper and lower price levels, which add further reinforcement of these areas. What happens next? Well, at some point, of course, the market finally breaks out from these regions, and this is the trigger we have been waiting for to either confirm the continuation of a current trend or to signal a reversal. And this really goes to the core of what we do when we look for breakouts. First, we have a current position in the market, and we see a breakout validated in our direction. This is a very clear signal of a continuation of the move and therefore gives us confidence to hold the position. Second, if we do not have a current position, this gives us an excellent entry signal once the move away has been validated with volume. And third, if we have an existing position and the trend reverses against us, and the trend reverses against us, we have been given a clear signal to exit. Finally, once the market has broken away from these regions, we then have a clearly defined platform for future price regions, which comes into play on both support and resistance. These are immensely powerful and helpful in giving us simple targets for managing existing positions based on the price action on our charts. If you remember back to something Ann wrote earlier, getting in is easy. It's getting out that is always the hardest part. Let's start with breakouts in volume and what we should expect to see as the market pulls away from these congestion zones. There we go. This is an ideal graphic of what we should expect to see. And in this case, we're seeing a bullish breakout. This could either be a continuation of a recent bullish trend higher where the market has paused before moving on once more, or this could be a reversal in trend. It doesn't really matter. The key points are the same and are these. First, for any break and hold out of congestion to be valid, we need to see clear water above the ceiling of the price action. Now, remember what I said earlier. These lines are not rods or steel. They're pliable rubber bands, and we have to treat them as such. So if the market ticks a few points above or below, this is not in itself a signal of a breakout. We need to see a clearly defined close above the ceiling. Now, as we can see on screen, the initial move higher up and through the ceiling has been accompanied by strong rising volume. Now, it takes effort for the market to move away, rather like dragging someone out of quicksand. The same applies here, and you should see this reflected in the associated volume of the next few bars. If you don't see this, then you know it's either a trap up move by the insiders or there is simply no interest from market participants to take the market higher at this point. Exactly the same principle applies when the breakout is in a bearish trend. Once again, it makes no difference whether this is a continuation of a bearish trend or a reversal from bullish to bearish. The only difference this time is we're breaking through the floor of price congestion and not the ceiling. Um, I guess I can't really stress strongly enough the importance of price congestion regions. These are one of the foundation stones of price action, and they reveal a lot and give us so many trading opportunities. There are many traders around the world who only trade on breakouts and nothing else, and we happen to be part of that group. We trade on breakouts. We wait for congestion to have for consolidate. It's also called consolidation. Once we define that area of consolidation, we look for breakouts, which often happen around our zones. Now, to round off this chapter, let's summarize the concept of support and resistance, which builds on the knowledge we already have of price congestion. And the analogy I always use here is of a house, which is why I have used the terms floor and ceiling to describe the upper and lower levels of price congestion. Now, imagine you're looking at a vertical cross section of a house, which is shown here on the screen. In other words, what we're looking at here is a house with the front removed, really like an old-fashioned dollhouse with the door open. Now you can see all the floors and ceilings in the house, and you can see here we have a ground floor, first floor, second floor, and a roof. Now the zigzag line represents the market, which has moved from the ground floor to the roof and back again. Now let me explain the price action on screen as it moves through the house to better visualize the concept of support and resistance. The market moves higher from the ground floor and eventually reaches the ceiling, where it moves into sideways price congestion. At this point, the ceiling is providing an area of price resistance to any further move higher for the market. However, at some point, the ceiling is breached and the market climbs through to the first floor level. What was the ceiling of the ground floor has now become the floor of the first floor. Yeah. In other words, an area of price resistance has now become an area of price support. The market continues higher until it reaches the ceiling of the first floor, where once again the price moves into a consolidation phase. Eventually, it breaks out into the second floor level. Again, price resistance as represented by the ceiling of the first floor is now support as represented by the floor of the second floor. It's kind of like the party of the first part represents the party of the second part. Finally, the market continues higher until it reaches the ceiling of the second floor, where the price resistance proves to be too strong, and the market reverses at this level. The ceiling has remained firm, and the barrier of price activity has prevented the market continuing further. The market then moves lower, having reversed back to the floor where it consolidates before breaking through and back down through the floor and past the ceiling of the first floor level. Here we see the reverse in action. What was price action in terms of the floor has now become price resistance in terms of the ceiling. Now, this is repeated at the first floor level before the market breaks lower, with the floor of price support now becoming price resistance in the ceiling, and we are back to square one again. But why is this concept so important? Well, support and resistance is important for a number of reasons. First, as we have already seen, a breakout from a consolidation phase can be validated with volume, and if confirmed, provides excellent trading opportunities, the so-called breakout trades, the ones that we do. Second, and perhaps just as important, the reason this trading approach is so popular is it embraces in its strategy the whole concept of support and resistance, which is this: that in creating these regions and using them as a part of the trading strategy, you are in effect using the market's own price behavior to provide you with protection on your positions. By this, I mean in trading using a breakout, the market has created its own natural barriers to protect you against any sudden changes in market direction as the trend develops. This is a win-win. You have the comfort of knowing once the market is broken through a ceiling of price resistance, not only does this become a floor of price support, it also becomes a barrier of price protection in the event of any short-term retest of this area. Any stop loss, for example, could then be placed in the lower region of the price congestion. This is why breakout trading is so popular, and when backed with VPA validation, becomes even more powerful. Okay. That's it, guys. That is chapter 7 on support and resistance. We can do some questions at this point if you'd like. We're going to go on to trading here in a minute. But once you just really understand the support and resistance, what we call our zones, you really start to see the consolidation and the breakouts happen in those areas.